Silver breaking decisively above the $77 level is not just a commodity headline. It is a signal that confidence in the global monetary order is being stress-tested in real time. This move reflects synchronized pressure points, tightening physical supply, rising geopolitical fragmentation, and accelerating diversification away from dollar-centered reserves. What makes this moment urgent is that silver is rising alongside, not instead of, other safe haven assets, suggesting defensive positioning rather than speculative excess. Capital is repositioning quickly as investors reassess currency risk, sovereign debt sustainability, and the long-term credibility of monetary policy frameworks. Unlike short-lived price spikes, this surge is occurring amid declining liquidity, elevated real-world demand, and policy uncertainty across major economies. When a historically secondary monetary metal behaves like a primary reserve hedge, it raises uncomfortable questions about where trust is eroding and how fast capital flows can reshape financial stability. Silver's current price behavior must be understood as the outward manifestation of a deeper, structural realignment in global demand rather than the product of a transient speculative episode. The move beyond the $77 threshold represents not a psychological overshoot driven by leveraged enthusiasm, but a repricing event occurring at the intersection of constrained supply, inelastic industrial necessity, and a strategic reassessment of tangible assets by institutional and sovereign actors. This distinction is critical. Speculative rallies tend to be sharp, liquidity-driven, and reversible once positioning unwinds. What is unfolding now is materially different in composition, duration, and implication, and it is taking place against a backdrop of mounting stress within both real economy supply chains and the financial architecture that intermediates them. At the core of the current surge is a supply structure that has been quietly deteriorating for more than a decade. Global silver mine production has failed to exhibit meaningful growth despite sustained increases in nominal prices and expanding downstream demand. This is not the result of cyclical inefficiency, but of structural underinvestment that began after the last commodity supercycle and was compounded by regulatory friction, rising capital costs, environmental constraints, and declining ore grades. A significant portion of global silver production is derived as a byproduct of base metal mining, particularly copper, lead, and zinc. This byproduct dependency limits responsiveness to silver-specific price signals. Even at elevated price levels, output cannot be rapidly scaled unless base metal economics independently justify expansion. As a result, supply elasticity remains structurally low, and price signals increasingly transmit through inventories rather than production adjustments. Inventory levels themselves have become a central point of vulnerability. Above-ground silver stocks, particularly those available for immediate delivery, have been drawn down steadily to meet both industrial consumption and rising physical investment demand. Unlike financial assets, silver inventories cannot be replenished through balance sheet expansion or policy intervention. Each ounce consumed industrially is effectively removed from the market for extended periods, often permanently, depending on end-use recovery rates. This dynamic is particularly pronounced in sectors where silver is embedded in complex components or dispersed across large-scale infrastructure, making recycling economically or technically unviable at current thresholds. As inventories thin, the market becomes increasingly sensitive to marginal changes in demand, amplifying price movements even in the absence of speculative leverage. Industrial demand represents the most underestimated driver of this repricing. Silver's role in energy transition infrastructure has shifted from supplementary to essential. Photovoltaic solar cells, advanced power grids, electric vehicles, and energy storage systems all rely on silver's unmatched electrical conductivity, thermal stability, and corrosion resistance. While manufacturers have pursued thrifting strategies to reduce per-unit silver usage, these gains have been offset by sheer volume growth. Global deployment targets for renewable energy capacity are accelerating, not decelerating, as governments respond to energy security concerns and climate mandates simultaneously. This locks in a baseline level of silver consumption that is largely insensitive to price, particularly when silver represents a small fraction of total system costs, but a critical component for functionality and reliability. Beyond energy, silver's importance to advanced electronics and semiconductor manufacturing continues to expand. As devices become more complex and miniaturized, performance tolerances tighten, favoring materials with superior conductive properties. Silver-based pastes, solders, and coatings are increasingly difficult to substitute without sacrificing efficiency or durability. Defense and aerospace applications further reinforce this demand profile. Modern weapon systems, secure communications, and satellite technologies incorporate silver extensively due to its reliability under extreme conditions. These sectors operate under national security imperatives rather than price optimization, rendering their demand highly inelastic. Once procurement cycles are established, consumption continues irrespective of market volatility. Overlaying industrial demand is a growing layer of strategic accumulation that distinguishes the current environment from previous cycles. Institutional investors, sovereign-linked funds, and state-affiliated entities are increasingly allocating capital to physical silver not as a trade, but as a strategic asset. This behavior is informed by a reassessment of systemic risk rather than an expectation of short-term price appreciation. Silver occupies a unique position in this context. It is globally recognized, outside the credit system, and free from counterparty exposure. While gold remains the primary monetary metal, silver offers scale, divisibility, and accessibility that make it attractive for diversification at larger volumes. Importantly, these accumulators are demonstrating longer holding horizons and a preference for allocated deliverable metal rather than paper exposure. Market data supports this shift in behavior. Physical delivery requests on major exchanges have increased relative to open interest, while lease rates and backwardation episodes indicate localized tightness in available supply. Unlike speculative episodes characterized by expanding futures positions and rapid turnover, current flows suggest a deliberate effort to secure access rather than exploit volatility. This is reinforced by declining liquidity in certain segments of the market, where sellers are increasingly reluctant to part with physical holdings despite rising prices. Such behavior is inconsistent with momentum-driven speculation and instead reflects a recalibration of perceived value and risk. The monetary dimension of silver demand cannot be separated from broader macro-financial conditions. Persistent fiscal deficits, expanding sovereign debt burdens, and the politicization of financial infrastructure have prompted a gradual reassessment of reserve composition and asset safety. While this process is incremental, it is cumulative. Silver benefits from this environment as a non-sovereign store of value that is less encumbered by historical stigma than in previous decades. Unlike purely financial hedges, silver's value is anchored in real economy utility, providing a dual function that enhances its appeal during periods of monetary uncertainty. This duality reduces downside risk and supports higher equilibrium pricing when confidence in fiat frameworks weakens. Crucially, the current repricing is occurring without the hallmarks of excess that typically precede corrections. There is no evidence of widespread retail leverage, euphoric sentiment, or indiscriminate inflows detached from fundamentals. Instead, participation is concentrated among actors with long-term mandates and risk management frameworks that prioritize preservation over performance chasing. This composition alters market dynamics. When price discovery is driven by entities unwilling to sell into strength, upward adjustments tend to be stepwise and durable rather than parabolic and reversible. The interaction between constrained supply and diversified demand creates a feedback loop that reinforces higher price levels. As prices rise, marginal demand does not collapse because much of it is non-discretionary. Simultaneously, higher prices do not unlock proportional supply due to structural constraints. This asymmetry allows the market to establish new clearing levels that would have been unsustainable in earlier cycles. Over time, these levels become reference points for contracts, procurement planning, and asset allocation models, embedding higher prices into the economic fabric rather than treating them as anomalies. This structural shift carries broader implications for financial stability and industrial policy. Persistent silver strength introduces cost pressures into critical supply chains at a time when inflation sensitivity remains elevated. It complicates monetary policy transmission by reinforcing the signaling function of hard assets as hedges against currency debasement. It also exposes vulnerabilities in just-in-time inventory models that assume abundant access to key inputs. As silver's price behavior continues to diverge from purely cyclical patterns, it challenges long-held assumptions about commodity market resilience and the substitutability of strategic materials. In this context, the move past $77 should be interpreted not as an endpoint, but as a recalibration marker. It reflects the market's attempt to reconcile competing realities: finite physical supply, expanding real-world demand, and a financial system undergoing gradual but consequential stress. Absent a significant contraction in industrial activity or a structural increase in production capacity, neither of which appears imminent, the forces underpinning silver's surge remain active. The repricing underway is therefore less about exuberance and more about adjustment, as the market aligns valuation with scarcity, utility, and strategic relevance under evolving global conditions. What distinguishes this phase is its quietness. There is no singular shock, no dramatic announcement, no overt crisis catalyzing the move. Instead, the adjustment is occurring through accumulation, delivery, and deferred selling, mechanisms that rarely attract immediate attention but exert powerful influence over time. This is often how structural shifts manifest: gradually, persistently, and with increasing resistance to reversal. By the time consensus recognizes the change, the repricing is already embedded. Silver's current trajectory suggests that such a transition is not hypothetical but already in progress, reshaping expectations and recalibrating risk assessments across markets that depend on both its physical and monetary roles. Rising silver prices are increasingly functioning as a diagnostic indicator of stress within the dollar-based financial system, rather than as a simple reflection of commodity market dynamics. The current appreciation of silver must be interpreted within the broader context of a global monetary order that is undergoing incremental but persistent strain. This strain is not the product of a single shock or crisis event, but of cumulative pressures that have been building across fiscal policy, geopolitical alignment, financial infrastructure, and reserve management. Silver's behavior is notable precisely because it occupies a peripheral yet highly sensitive position within the global asset hierarchy. When capital begins to move decisively into such an asset, it often reflects underlying concerns that are difficult to express directly within larger, more liquid markets dominated by policy intervention and institutional inertia. At the center of this dynamic is the expanding scale and persistence of U.S. fiscal imbalances. The United States continues to finance large structural deficits through sustained debt issuance, relying on the depth and perceived safety of Treasury markets to absorb supply. While demand for U.S. government debt remains robust in absolute terms, its composition is shifting. Foreign official participation has plateaued or declined in relative terms, while domestic absorption increasingly relies on financial institutions, investment funds, and, indirectly, the central bank's balance sheet policies. This evolution matters because it changes the nature of confidence underpinning the dollar. Yield differentials alone are no longer sufficient to explain continued demand. Political stability, institutional continuity, and the perceived neutrality of the financial system are becoming more decisive variables. Simultaneously, the use of the dollar-centered financial system as a tool of geopolitical leverage has altered risk perceptions among global capital holders. Sanctions regimes, asset freezes, and restrictions on payment systems have demonstrated that access to dollar liquidity and dollar-denominated assets is contingent not only on market participation, but also on political alignment. While these tools have been deployed selectively and with strategic intent, their broader signaling effect has been profound. Sovereign wealth funds, central banks, and large institutional investors are increasingly incorporating political risk into currency and asset allocation decisions. This does not imply an abrupt rejection of the dollar, which remains deeply embedded in global trade, finance, and reserves. Rather, it encourages a gradual diversification away from excessive concentration, particularly in forms that can be immobilized or devalued through policy action. Silver benefits directly from this reassessment because it exists entirely outside the sovereign credit framework. Unlike government bonds or bank deposits, silver carries no issuer risk and no dependency on payment systems or legal jurisdictions for its validity. Its value does not rely on the solvency of a counterparty or the credibility of a promise. In periods when institutional trust is questioned, assets with these characteristics gain relevance even if they are not intended to replace dominant reserve currencies. Silver's advantage over gold in this context lies in its relative accessibility and scalability. For entities seeking to diversify incrementally rather than make symbolic gestures, silver allows meaningful allocation without the concentration and visibility associated with gold transactions at scale. The current environment of stabilizing U.S. interest rates further accentuates this trend. As monetary tightening cycles approach their terminal phase, the marginal support provided by higher yields diminishes. At the same time, elevated debt servicing costs constrain fiscal flexibility, reinforcing concerns about long-term sustainability. When yield becomes less responsive while issuance remains elevated, confidence shifts from quantitative metrics to qualitative assessments of governance, policy coherence, and institutional resilience. This transition is subtle but consequential. Markets that once treated the dollar as an unquestioned anchor begin to price in scenarios where policy inconsistency or political dysfunction erodes real value over time. Silver's price action suggests that a segment of the market is already positioning for such an environment, seeking insulation from gradual currency dilution rather than immediate crisis. Fragmentation of global trade alliances compounds these pressures. The reconfiguration of supply chains, the rise of bilateral and regional trade arrangements, and the increasing use of local currencies in settlement all reduce the automaticity of dollar demand. While these shifts are uneven and incomplete, they weaken the feedback loop that historically reinforced dollar dominance. In this context, reserve managers face a more complex optimization problem. They must balance liquidity and return against resilience and optionality. Silver, though not a reserve asset in the traditional sense, offers a form of optionality that is increasingly valued. It provides exposure to a globally recognized store of value that is not directly tied to any single economic bloc or policy regime. The visibility of these reallocations is most apparent in markets with limited depth, where incremental flows can exert disproportionate influence. Silver's market is significantly smaller than that of major currencies or sovereign bond markets. As a result, even modest strategic shifts can produce outsized price movements. This does not imply volatility driven by speculation. Rather, it reflects the sensitivity of the market to changes in allocation behavior among a relatively small cohort of large actors. When silver prices rise in this manner, it often precedes or accompanies broader shifts that later become evident in larger, more opaque markets. In this sense, silver functions as an early warning indicator, revealing adjustments that are otherwise absorbed quietly within the balance sheets of major institutions. Importantly, the current signal should not be misconstrued as an imminent loss of dollar primacy. The dollar remains unparalleled in its liquidity, network effects, and institutional support. However, primacy does not equate to invulnerability. The erosion of unquestioned confidence can occur long before measurable displacement. Silver's ascent suggests that trust is becoming more conditional, more contingent on policy outcomes, and more sensitive to long-term trajectories rather than short-term performance. This is consistent with a world in which investors and policymakers alike are grappling with higher uncertainty and reduced tolerance for concentration risk. The implications of this shift extend beyond asset markets. A gradual reallocation toward tangible, non-credit assets reflects a broader recalibration of how value and security are defined in the global system. It challenges assumptions about the permanence of existing monetary arrangements and highlights the importance of credibility as a scarce resource. For policymakers, this underscores the need to manage not only economic fundamentals, but also the perception of institutional integrity. For market participants, it reinforces the necessity of understanding price signals that originate outside conventional financial instruments. Silver's breakout, therefore, should be read as a message rather than an anomaly. It indicates that a portion of global capital is responding to systemic signals that are difficult to express through traditional hedges. These signals include concern over fiscal trajectories, unease with the politicization of finance, and recognition of a more fragmented geopolitical landscape. The fact that these responses are manifesting first in silver is a function of market structure and asset characteristics, not of marginal importance. Historically, such peripheral markets have often been the first to reflect shifts that later reshape the core. As the current situation continues to unfold, the persistence of silver's strength will remain a critical data point for assessing the depth and durability of stress within the dollar-based financial system. Financial markets may be significantly underestimating the systemic implications of sustained strength in silver prices, largely because silver has historically been treated as a secondary asset whose movements were assumed to be either cyclical or idiosyncratic. That assumption is increasingly untenable. When silver remains elevated over an extended period, the effects propagate far beyond the confines of precious metals trading desks and into the structural mechanics of industrial production, inflation transmission, portfolio construction, and macrofinancial stability. The present environment is especially sensitive to these dynamics because it combines tight physical supply, strategic demand, and a fragile equilibrium across monetary and fiscal systems. Silver's persistence at high price levels is therefore not a marginal phenomenon, but a stressor that interacts with multiple layers of the global economy simultaneously. One of the most immediate and tangible impacts of sustained silver strength is pressure on industrial margins. Silver is not a discretionary input in many of the sectors that define current growth and policy priorities. Renewable energy infrastructure, including photovoltaic solar panels, relies heavily on silver for conductive pathways that cannot be easily substituted without sacrificing efficiency or durability. Advanced electronics, power management systems, medical devices, and high-performance semiconductors all incorporate silver in quantities that are small relative to unit cost but critical to functionality. When silver prices rise sharply and remain elevated, manufacturers face a narrowing set of options. Absorbing higher costs compresses margins in industries already contending with labor shortages, energy volatility, and regulatory compliance burdens. Passing costs through to end users risks demand elasticity effects and political scrutiny, particularly in sectors that are publicly subsidized or strategically sensitive. These pressures are magnified by the structure of modern supply chains. The global manufacturing system is optimized for cost efficiency under conditions of predictable input pricing and abundant availability. Sustained silver strength undermines both assumptions. As inventories are drawn down and replacement costs rise, firms are forced to hold higher working capital buffers, increasing financing needs and reducing flexibility. Smaller suppliers, particularly those operating in emerging markets or at lower tiers of the supply chain, are disproportionately affected. They often lack the pricing power or balance sheet resilience to absorb volatility, leading to consolidation risks or production bottlenecks. Over time, these frictions can cascade upward, disrupting timelines and increasing costs for finished goods in ways that are difficult to reverse quickly. From a macroeconomic perspective, silver's elevation feeds into inflation dynamics through channels that are often overlooked. While silver itself represents a narrow component of consumer price indices, its role in enabling key technologies gives it an outsized indirect influence. Higher costs in renewable energy infrastructure can slow deployment or raise electricity prices over time, counteracting policy efforts to stabilize energy costs. In electronics and technology, cost pressures can lead to delayed upgrades, reduced feature sets, or higher prices for capital goods that feed into productivity across multiple sectors. These second-order effects complicate central bank efforts to manage inflation expectations, particularly in environments where headline inflation has moderated but structural cost pressures remain embedded. The investment implications are equally significant. Sustained silver strength challenges conventional asset correlation frameworks that underpin portfolio construction and risk management. Traditionally, silver has been modeled as either a high-beta precious metal correlated with gold or as an industrial commodity linked to growth cycles. Its current behavior defies these categories. Silver is exhibiting characteristics of a strategic asset that responds to monetary uncertainty, supply constraints, and industrial demand simultaneously. This hybrid profile reduces the reliability of standard diversification strategies, particularly those that assume predictable relationships between equities, bonds, commodities, and currencies. When such assumptions fail, hedging becomes less effective, and portfolio volatility can increase even in the absence of overt market stress. This recalibration extends to broader commodity markets. Sustained silver strength alters relative pricing signals within the metals complex, influencing capital allocation decisions and production economics. It can distort incentives for substitution, recycling, and technological redesign, often with long lead times and uncertain outcomes. For example, attempts to reduce silver content in solar panels may accelerate research into alternative materials, but such transitions require years of testing, certification, and scaling. In the interim, elevated prices persist, reinforcing the very scarcity they signal. These dynamics contribute to a feedback loop in which markets struggle to clear efficiently, leading to periodic dislocations that are misinterpreted as volatility rather than structural adjustment. Currency and interest rate expectations are also affected, albeit indirectly. Silver's sustained elevation sends a signal about confidence in real assets versus financial claims. When investors allocate capital to silver despite higher yields available elsewhere, it suggests a preference for insulation from systemic risk over income generation. This behavior complicates the transmission of monetary policy. Central banks rely on interest rates to influence capital flows, borrowing costs, and asset valuations. If a growing share of capital prioritizes safety from dilution or disruption, rate adjustments become less potent. This does not render monetary policy ineffective, but it does reduce its precision and increases the lag between action and impact. The systemic risk posed by sustained silver strength is therefore not one of sudden collapse, but of gradual destabilization. It operates through the erosion of assumptions that underpin market efficiency and policy effectiveness. Liquidity, for example, is often treated as a given in developed markets, supported by deep pools of capital and institutional participation. However, when assets like silver experience persistent demand that outstrips available supply, liquidity can become episodic. Spreads widen, delivery times lengthen, and price discovery becomes more discontinuous. These conditions can spill over into related markets, particularly those that rely on silver-linked instruments or collateral structures. Reserve safety assumptions are also tested. While silver is not a reserve asset in the traditional sense, its behavior influences perceptions of what constitutes a reliable store of value. If silver continues to perform strongly in environments of fiscal expansion and geopolitical fragmentation, it reinforces the narrative that tangible assets offer protection against policy-driven risks. This narrative, once established, can alter behavior across a range of actors, from central banks adjusting marginal allocations to corporations revisiting treasury management practices. Such shifts are incremental and often invisible in headline data, but their cumulative effect can be substantial. Markets have a consistent tendency to price structural adjustments only after they become unavoidable. Early signals are often dismissed as anomalies, especially when they emerge from markets perceived as peripheral. Silver's current behavior fits this pattern. Its strength is frequently attributed to transitory factors or localized supply issues, rather than being integrated into a broader assessment of systemic conditions. This mispricing persists until reinforcing evidence accumulates across multiple channels, at which point adjustment occurs rapidly and with limited opportunity for orderly repositioning. The present situation suggests that these signals are already active. Silver's sustained elevation is intersecting with policy challenges, industrial constraints, and investment behavior in ways that are mutually reinforcing. The absence of immediate crisis should not be interpreted as absence of risk. On the contrary, slow-moving instability is often more difficult to manage because it erodes resilience gradually, leaving systems less capable of absorbing shocks when they eventually occur. In this context, silver's role is less that of a trigger and more that of a barometer, registering pressure changes that are otherwise diffused across the global economy. Understanding and monitoring this dynamic is therefore essential for any comprehensive assessment of financial stability. Silver's current trajectory forces a reconsideration of how systemic risk is identified and priced. It highlights the importance of integrating real economy constraints with financial market analysis, rather than treating them as separate domains. As long as silver remains elevated and demand remains resilient, the underlying message is clear. The global system is adjusting to a new configuration of scarcity, trust, and value. Whether markets respond proactively or continue to underestimate the implications will shape the path of that adjustment and the stability of the economic environment in which it unfolds.